Hi, I'm Bob Hoff of Mountain State Financial Group, and here's your weekly update. Rates continue soaring higher as talks continue surrounding raising the national debt limit. Excluding the 15-year jumbo program, rates rose by an average of 0.259% APR since last week Wednesday. The U.S. Bureau of Labor Statistics released April's Producer Price Index, indicating prices increased by 0.2% from March to April, with an annual increase of 2.3%, better than the anticipated 2.5%. This was an important number as it confirmed what the Consumer Price Index data pointed to days earlier. Inflation is slowly falling. In addition, both initial jobless claims and continuing claims rose and were higher than anticipated 2 weeks ago and fell again last week. Although markets are still anticipating that the Fed will pause their rate hikes in June, that likelihood has been falling, while the likelihood of a 25 basis point increase is rising. Fed Governor Michelle Bowman stated that the Fed would probably need to raise rates even higher, but fell short of suggesting that the increase would be needed during their June meeting. Meanwhile, Fed Chair Powell indicated that already tightening credit conditions in the market would curb pressures to raise rates further. The Fed's June meeting is still 3 weeks away, and much can happen between now and then to swing their sentiment about raising rates. The U.S. Census Bureau released its April retail food service and sales report, which increased by 0.4% over March and 1.6% since April 2022, led higher by online and auto sales, signaling strength in consumer spending. While this report implies economic growth, the Empire State Manufacturing Survey showed a decline in business activity as businesses brace for slowing demand and a softening labor need in the upcoming months. We continue to see a somewhat contradictory data with regards to the strength of the economy and the likelihood of a recession. The debt ceiling and impending default, if not raised in time, have had the greatest impact on mortgage rates over the last couple weeks. The U.S. has never defaulted on its debt obligations, no one's certain exactly how damaging that would be. For mortgage rates, this would likely lead to a meaningful move higher as investors search for a higher risk premium. Although our public servants in Washington and Congress seem to agree that the ceiling should be raised, they haven't been able to come to an agreement as to what that would look like. As prudent financial professionals, it seems clear to us that the debt ceiling should indeed be raised to avoid default. However, if our leaders do nothing other than raise the debt ceiling without taking measures to rein in our tax revenue/government expenditure mismanagement, it'll become harder to deal with as time goes on, which is why we're hitting the debt ceiling again. As our debt climbs, so does the interest expense the country has to pay to service this debt. When left unchecked, the cost of servicing this debt will continue to rise until the nation has no choice but to dramatically raise taxes, painfully cut spending, a combination of both, and/or finally default on its obligations. Dealing with this mismanagement now would be less painful than in the future. However, it is politically easier to simply continue raising the debt ceiling and let others deal with the consequences down the road. Unfortunately, there will be approximately zero accountability for today's public servants if and when our nation reaches that critical point. May our leaders always act in the best interest of those they serve. Mortgage interest rates have been trending higher as the national debt inches toward the ceiling. If the debt ceiling is raised in a timely manner without complications, we could see a meaningful improvement in mortgage rates. But until that happens, lock. As always, if you have any specific questions or scenarios you'd like to discuss, our team is happy to help. Again, I'm Bob Hoff, Mountain State Financial Group, and this is your weekly Rates and Updates.